Both of these are kind of like Lending Marketplace 1.0. Enter Lending Marketplace 2.0. They've got a $40 million reduction in bank fees and funding costs. Boom, right off the bat. What LendingClub has done is they have turned their competitors, fintech lenders, into their partners, into their producers. Is lending a winner-take-all market? And the answer is absolutely. Yesterday, I spoke about the Morgan Stanley E-Trade deal and how we're just going to continue to see more commoditization, kind of a race to a bottom with what fintechs are bringing to the traditional incumbents. The LendingClub Radius Bank deal is fantastic. I think it's a genius move on their part, and it's a relatively small deal. I mean, when we look at LendingClub's market cap here, they're at $1 billion. If you look at the past 5 years, however, they used to be $100 a share. Now they're at basically $11 a share. And the story of LendingClub is that it actually, started out as peer-to-peer lending. And then it started to move from peer-to-peer lending, which is still available, but a lot of it is really a majority of their lending is coming from a few large institutions. So it's kind of lost some of that supply side network effect. It's become more of kind of an institutional lender. And so what this Radius Bank deal is, this is a return to a true lending marketplace model, but kind of like version 2.0 lending marketplace, right? You kind of saw a lot of version 1.0 lending marketplaces where they were peer-to-peer. LendingClub was in Platt when it had the right market cap requirements. Now it doesn't. But LendingTree would be another example of a 1.0 lending marketplace. LendingTree is more of a referral engine than it is going end to end on actually having a producer as a lender and delivering those monies to the borrower, right? So LendingClub is an end to end lending marketplace, but less on the marketplace side over the past few years. LendingTree, more of a referral engine. LendingTree really isn't going end to end. You go there and they connect you to potential lenders, and then LendingTree gets basically a referral fee for that. Both of these are kind of like Lending Marketplace 1.0. Enter Lending Marketplace 2.0. This Radius Bank acquisition, what is it doing for LendingClub? So they're getting a couple things. They're getting a banking license. So now when you get a loan through LendingClub, you're going to get a checking account. And now when that loan is, when you receive those monies for that loan, those monies are going to be probably deposited into your LendingClub checking account. And so this is automatically going to save fees for LendingClub to just keep the banking relationship inside of their own business. And so they've got a $40 million reduction in bank fees and funding costs. Boom, right off the bat. Okay. In terms of synergies of buying this company. The real value add here, though, is about the APIs and banking as a service business of Radius Bank. So LendingClub's long-term vision is to become what it calls a marketplace bank. That means pursuing a platform strategy, ding, 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 attracting both buyers and sellers, borrowers and savers being consumers, and lenders and investors being producers, and providing transaction integration and processing capability. With Radius Bank's APIs and existing fintech relationships, LendingClub takes a big step forward towards becoming a multi-line platform. What this is saying is that there are a myriad of fintech lenders. We've covered fintech lenders and fintechs on the show many, many, many times. Fintech lenders have a big cost of customer acquisition problem. How do they get to scale in a cost-effective manner? And if you look at their CAC to LTV ratios, they're all out of whack. Ideally, you have at least a 3-to-1 LTV to CAC ratio, right? So fintech lenders have a problem of getting scale. Fintech lenders can make money lending to a lot of borrowers that traditional banks would never be able to lend to, LendingClub included, because LendingClub is really more of an institutional lender today than it is kind of a peer-to-peer lending marketplace as it kind of used to be, right? So if you were to look at any traditional bank, and probably LendingClub for this is similarly in this example, and you say, how many personal lenders and small businesses, you traditional bank and you LendingClub, are you turning down? And I would be willing to bet that probably at least 30 to 50% of those personal loans or small business loans that the bank is turning away could be fulfilled successfully, profitably, by a third-party fintech lender, because the third-party fintech lender is going to be more innovative, use different data sets, and their underwriting model and their underwriting restrictions are going to be more flexible for them to extend credit to people that a institutional lender is not going to feel comfortable doing. So what LendingClub has done is they have turned their competitors, fintech lenders, into their partners, into their producers, into saying, hey, I'm going to let you, fintech lender, lend to borrowers that we can't lend to. And I'm going to let you, fintech lender, compete on price, loan amount, term, right? What's the interest rate that you're going to provide to the borrower? And that's what the borrower is going to make a decision on, right? They want to get a loan over the right term for the right amount at the best price. So now by creating a marketplace, I can drive and I can force, who's going to win the buy box, right? Just on Amazon Marketplace, all the third-party sellers are competing for the buy box. Who presents the best price gets to win the buy box. So all of these fintech lenders, same thing. Who wins that optimal buy box for the borrower? And then the borrower clicks, yep, I'll take that loan. But the role of a lender is commoditized. Do I really care who the lender is? No, I just want to make sure I'm getting my money at the right rates, and and that it's through a trustworthy organization. And that's what the platform is going to do. The LendingClub platform. LendingClub, with this checking account capability, is now going to be able to service and maintain the loan on behalf of fintech lenders. Fintech lenders are good at lending money, but they aren't really good at collections and repayments. There's a lot of infrastructure that goes into that. So the platform is going to be able to go end to end. This is a lending marketplace 2.0. The LendingClub business model, they haven't released this yet, but if I was to guess, LendingClub could take an origination fee, and the fintech lender won't get an origination fee, but they can earn their money on the interest. But still, compared to the CAC that a fintech lender is paying to acquire every new customer, this is going to be way cheaper for them to not take an origination fee than it would be for them to pay for their other customer acquisition channels that they're using today. So it's a win-win-win for everyone. It's a win for the borrower, because they're going to get arguably the best rates with fintech lenders competing over the borrower. Not to mention, you're going to have the most streamlined lending application process, because now the platform is going to be able to say you have one application and now you get multiple quotes, multiple offers from multiple lenders, but they're not going to hit your credit 5 different times, right? One application, one credit ping, boom, the platform vouches that the information is legit and then passes on that credibility to the producers, to the fintech lenders. The platform keeps the origination fee. The fintech lenders provide their quotes. The best option gets chosen by the borrower. The fintech lender makes money on the interest payments. And the platform could even take like a 1% servicing fee every year to facilitate all of the repayments and to handle collections if it goes down that route, right? This is a win-win-win. And this is what it really nets out to. Is lending a winner-take-all market? And the answer is absolutely. I think you're going to be able to see vertical specific lending marketplaces, just like we're seeing in B2C and in B2B product marketplaces. I think you're going to be able to see lending marketplaces be built around personal loans, small, medium-sized business loans, mortgages. If you actually look to Europe, there's actually a number of lending marketplace kind of startups that are vertical specific around mortgages or auto loans or personal loans. We're going to start to see the same thing in the United States, and large traditional incumbent banks better understand that where they make a majority of their revenue, it's called interest. Marketplaces are coming for that, and they're coming for it in a big way, and you don't need hundreds of banks lending money. It's not a convenient process. Borrowers don't get the best deals and the best rates. And the marketplace solves for all of this, and it's coming. And I think LendingClub is going to lead the charge. The good thing for banks is that they have a lot more scale than LendingClub has, right? LendingClub, their business has shrunk over the years from $100-something a share now to about $11 a share. So banks still have a lot more scale that if they started to move into this space, there are some pretty good acquisition targets that they could use to immediately take latent demand, the 30 to 50% of customers that they are turning down today, and offer them an alternative model, a lending marketplace model. We will see where this nets out. Hi, this is Alex from Winner Take All. Thanks for joining us. Hope you enjoyed the content. Feel free to leave a comment, ask us questions, and definitely make sure to join us on our next live stream.